If you own GLD or SLV, the biggest risk isn't the market, it's your finger. And in the first 10 seconds, here's the whole video so you know why you should stay. 1 mistake, 3 signs, and a 30-second protocol. So you don't turn a temporary gold-silver swing into a permanent retirement loss. As of this recording, I'm looking at the same kind of screen you are. Charts, headlines, candles, noise, and I'm telling you something that's uncomfortable but true. Most retirees don't get hurt in gold and silver because they picked the wrong metal. They get hurt because volatility pushes them into one predictable mistake. ETFs didn't create risk. They turned your hedge into a panic button, and the panic button is most tempting at the exact moment you're least qualified to press it. Now watch this, because this scene is the reason this video will save people money. You wake up, you don't even plan to trade, you just want to check quickly. You open your brokerage app. You see GLD and SLV moving fast, sometimes up, sometimes down, sometimes whipsawing like the market is trying to pull your attention out of your day and into your screen. Your heart rate changes before your brain finishes a sentence. Your shoulders tighten, and then your mind produces one line that feels responsible in the moment. I need to fix this. That sentence is the trap. Because in retirement, the enemy isn't a red day. The enemy is a permanent decision made during a temporary panic. Now I'm going to lock one credibility anchor so the comment section can't derail this with timestamp police arguments. Prices move minute to minute. If this were a produced video, I would show the on-screen quote source for a few seconds. TradingView, a broker feed, a Kitco-style quote, so you can match what I'm describing to the exact session you watched. But we are not building this video on exact prints. We are building it on behavior, and the behavior is the warning. Also, Bloomberg summarized a Bank of America note suggesting gold and silver volatility may remain elevated after the plunge from highs. In a produced video, I'd show that headline card on screen so you can verify the source instantly. But you don't need a bank to tell you the same thing your screen is already telling you. This is not a calm market environment. In a calm market, retirees can be casual. In a volatile market, retirees need a protocol. So here's the entire spine of this video. Clean, no detours. First, the one mistake that wipes out retirees. Then, the 3 signs that tell you whether today is calm or a trap. Then, the 30-second protocol that prevents the mistake. Then, the simplest retiree framework for gold and silver ETFs so you never have to improvise again. That's it. 1 mistake, 3 signs, 1 protocol, 1 framework. Let's go. Here's the 1 mistake that wipes out retirees in GLD and SLV. You change your role or your position size during the fear candle because the ETF makes it effortless to act fast. That's the mistake. Not wrong metal. Not wrong prediction, not wrong headline, wrong timing for a role size decision. You bought gold exposure for insurance or diversification. You bought silver exposure for optional upside or a hedge. Then a scary move hits, up or down, and you let emotion rewrite the role. You sell for relief. You buy for certainty. You resize because you want the feeling of safety back. And because it's an ETF, you can do it instantly, right when your nervous system is on fire. That's why this mistake is so common. It doesn't feel like a mistake while you're doing it. It feels like being responsible. And that's why it's so dangerous. Now, before we fix it, you need to recognize it in real time. So here are the 3 signs. 3 signs, short enough to remember, strong enough to use. Sign 1, hold versus give back. After the big move, does the market hold new ground or does it give it back quickly? Hold suggests acceptance. Fast give back suggests reaction. Sign 2, silver's wick behavior. Is silver moving cleanly, or is it printing long wicks both ways, up, down, up, like the market is hunting stops? Wicks both ways usually mean fragile conditions. Fragile conditions punish urgency. Sign 3, normalization versus persistence. Do the next sessions calm down, smoother moves, less jumpiness? Or does everything stay twitchy like the market's nervous system hasn't settled? Those 3 signs tell you whether you're in a calm acceptance environment or a trap environment. Now, let me make the silver warning visual so clear you can't unsee it. When gold looks relatively steady but silver is whipping and printing long wicks in both directions, that's not calm fear. That's fragile fear. Fragile fear is where retirees press the panic button. Now I'm going to give you one line that will save you from the most common mistake. I'm only going to hit it twice in this script, once now, once near the end, because repetition dulls power. First move is a proposal. The hold is the vote. Retirees get hurt when they trade the proposal. Retirees survive when they wait for the vote. Now the fix. This needs to be short enough to run when you're emotional. So I'm going to give you a 30-second protocol you can actually use. RVP. Retiree Volatility Protocol, role, regime, position size. Then timing and confirmation. Here's how you run it. Fast. Role. Why do I own this ETF exposure? Insurance or upside? 1 sentence. Regime. Based on the 3 signs, is today calm acceptance or a trap day? Position size. Can I ignore this position for a week without feeling compelled to act? If not, it's too big. Timing rule. No major roll size decisions in the first minutes after a violent move. Confirmation rule. Only adjust after the vote, after hold behavior, not during the proposal. That's it. That is the entire cure. And the reason it works is simple. It stops you from improvising under stress, because improvisation is what wipes out retirees. Now I can already hear the pushback, but I'm being responsible. I'm managing risk. Isn't it smart to act quickly? Sometimes, if you are following a written rule you created on a calm day. But most retirees aren't clicking because of a plan. They're clicking because of relief seeking. They're clicking because they want the uncomfortable feeling to stop. And markets punish relief seeking, not because markets are malicious, because relief seeking creates predictable order flow. Predictable order flow is where other participants find opportunity. So if you want to protect retirement savings, you don't just manage price risk, you manage behavior risk. And behavior risk is highest right after a scary candle. Now let's make this real, because retirees don't need theory, they need recognition. Here are 2 short scenes. Scene 1, relief selling. SLV has a huge single session move lower. Not a tiny wobble, a real gut punch day. Your chest tightens. You click sell because you want relief. Then silver snaps back because forced selling exhausts, or because liquidity returns, or because the story cools. Now you feel regret. You buy back higher because you don't want to miss the rebound. You paid twice. Not because you were wrong long term, because you acted during the fear candle. Scene 2, certainty buying. GLD spikes on uncertainty. You feel exposed. You click buy because you want certainty and protection. Then the market digests, the spike fades, and your safety position is immediately underwater. Now you feel regret. You fix again. More action, more whipsaw, more tax. That's the wipeout pattern. Not one terrible decision, repeated emotional decisions. ETFs make repeated emotional decisions easy. That's why panic button is not a metaphor. It's a description of what instant liquidity does to human behavior. Now, micro reset. Here's the rule you follow when your screen is loud. If you feel urgent, you are compromised. If you are compromised, you don't make major decisions. You run RVP, role, regime, size, timing, confirmation. Now I'm going to tighten the 3 signs into a shareable checklist because viral content spreads when people can repeat it without thinking. 3 questions, 10 seconds. Did it hold or give back? Is silver whipping with wicks both ways? Is the market calming down or staying fragile? If you answer those 3 questions, you're already ahead of most retirees who will click based on a feeling. Now let's talk about why today's prices matter without turning this into a comment war magnet. As of this recording, gold is roughly in the low 5,000s and silver is roughly in the high 80s. Again, exact prints change. In a real video, I'd show the source on screen. But here's what matters. Gold tends to express safety demand in a steadier way, while silver tends to express stress in a more violent way. So when silver is jumpy, it's often telling you the environment is fragile, even if gold looks calm. That is the volatility warning retirees can't ignore. Not because it predicts direction, because it predicts difficulty. It predicts that the market is going to try to pull you into action. And if you don't have a protocol, you will improvise. Now, let's remove the last excuse retirees use to justify clicking during fear. The excuse is, I'm doing this to be safe. Here's the uncomfortable truth. A lot of the most expensive retiree clicks are made in the name of safety. Selling at the bottom feels safe because it ends the pain. Buying at the top feels safe because it ends the fear of missing out. But ending pain is not the same thing as managing risk. Ending pain is emotion management, and markets punish emotion management when it's visible on the chart. So the goal is not never feel fear. The goal is never let fear write your role or your size. That's what RVP protects. Now I'm going to give you the simplest retiree framework so you never have to improvise again. 2 buckets. Insurance bucket, upside bucket. That's it. Insurance bucket means this exposure exists to protect the plan. It is sized to survive. It is not traded emotionally. Upside bucket means this exposure is optional. It is sized smaller. It can be volatile without forcing a plan change. For most retirees, GLD belongs in the insurance bucket. SLV, if you own it at all, belongs only in the upside bucket. Why? Because silver is an amplifier. It amplifies returns and it amplifies stress. And retirees cannot anchor their piece to an amplifier. Now this is where people argue, but silver can outperform. Yes, it can. And sometimes it will. But retirement is not a performance contest. It's a solvency contest. You don't need to win every rally. You need to avoid the permanent mistake. So the correct way to handle silver in retirement is not to make it your anchor. It's to make it optional. Optional means if it whips, you don't touch your plan. Optional means it cannot hijack your sleep. Optional means it cannot force you into a decision. Now here's the most honest sizing test in retirement. Can you ignore this position for a week? Not because you don't care, because you're not emotionally dependent. If you can't ignore it, if you're checking it constantly and it's hijacking your mood, it's too big. There is no safe asset at an unsafe size. You can make gold unsafe by sizing it too large. You can make silver survivable by sizing it small enough. So safety is not the ticker. Safety is roll plus size plus timing. Now let's talk about the specific ways ETFs magnify this mistake, but without adding another 3 list. One thought, clean. ETFs make acting easy. When acting is easy, acting becomes the default response to emotion. So retirees start trading their feelings instead of following their roles. That's the entire hazard. So one of the highest ROI moves retirees can make is to add friction back into the process. How? Not by doing something complicated. By using RVP and a timing rule. No major decision on fear candles. Decisions are made on calm days. That's friction. Friction saves you. Now, I want to address a comment that always appears. What if I truly need to reduce risk today? If your allocation is genuinely too large for your plan, that's a structural issue. Structural issues should be fixed structurally, on calm days with preset rules, not on fear candles, because fear timing produces bad prices and bad decisions. So the best framework is reduce size when you're calm, not when you're scared. That is decision timing, not market timing. Retirees don't have to time the bottom. They have to time their decisions when their nervous system is stable. Now, micro reset. Here's the trap. The trap is thinking speed equals control. ETFs make you feel like you can control risk with speed, but in volatile regimes, speed often turns you into the other side's liquidity. You sell when stronger hands want to buy, you buy when stronger hands want to sell. That's why donating liquidity is a useful phrase. It's not an insult, it's a description. Now let's make the 3 signs more concrete so you can recognize them without being a chart nerd. Hold versus give back. If GLD spikes and then stays above the breakout area for hours or days, that's holding. If it spikes and then fades back into the prior range quickly, that's give back. If SLV dumps and then reclaims the level and holds, that's a vote to reject the dump. If it dumps, bounces weakly, and keeps failing, that's acceptance of lower levels, at least temporarily. Silver wicks. Wicks both ways mean uncertainty and stop hunting. It means conviction gets punished. So in that environment, retirees should not size up. Normalization. If the next sessions calm down, smaller ranges, smoother moves, the shock is digesting. If the next sessions remain twitchy, big ranges, whipsaw, the regime is still active. Retirees should not make permanent decisions in active regimes. They should follow protocol. Now, I'm going to add one simple analogy that makes this easier for non-traders without sounding like a lecture. Think of gold like a seatbelt. Think of silver like a turbo. A turbo can help you go faster, but you don't install a turbo as your safety system. Gold belongs in safety. Silver belongs in optional performance if you can tolerate it and keep it small. That's the 2-bucket framework in plain English. Now let's address the single biggest reason retirees click wrong with ETFs, constant visibility. With physical metals, you can't refresh the price every 30 seconds. With ETFs, the price lives in your pocket. Your brokerage app is built to make you look. Looking creates emotion. Emotion creates action. Action creates whipsaw tax. So, one of the best retiree strategies in volatile markets is reducing the number of times you check, not because you're ignoring reality, because you're reducing urgency. And urgency is what markets tend to punish. Now, I'm going to tighten everything into a simple before you click script you can literally say out loud. Before you click, you say, what is my role? What kind of day is this? Hold or give back? Is silver whipping with wicks? Is the market calming or staying fragile? Can I ignore this for a week? If you feel urgent, you do not click, you wait for the vote. Now, I'm going to connect this back to the title in one crisp truth so the video feels complete. Today's prices reveal the one mistake, because today's prices reveal whether you're reacting to noise or acting from a role. If you feel compelled to act immediately because of today's candle, that is your warning. Not about gold, not about silver, about you. It means your structure is weak. Either the role is unclear, or the size is too big, or the timing rule doesn't exist. And weak structure gets punished in volatile regimes. So the correct response is not to click faster. The correct response is to strengthen structure. Now, a quick note for US and Australian retirees, because this matters and I'll keep it short. Currency and news cycles can amplify your emotional ride. Gold and silver are global, but you experience them in your currency. That can make swings feel larger and more urgent, so sizing discipline matters even more. If currency moves amplify your metal swings, the panic button becomes more tempting, so you must size so you are not forced. Now, I'm going to keep wrapper talk to 2 lines because it helps, but we're not turning this into a wrapper debate. ETFs are liquid, which is useful, but liquidity makes panic selling easy. Physical has friction, which can protect against impulsive selling, but can also make you feel trapped if you oversize. Pick the wrapper that reduces impulsive behavior for you. Now the closing, clean, memorable, and viral. As of this recording, gold and silver are volatile enough that Bloomberg summarized Bank of America's view that turbulence may remain elevated after the plunge from highs. That means more proposal candles, more trap days, more moments where the panic button will feel tempting. The one mistake that wipes out retirees is using GLD SLV like a panic button, changing role or size during the fear candle. Use the 3 signs, hold versus give back, silver wicks, normalization versus persistence. Run RVP, role, regime, size, then timing and confirmation. And here's the line again, for the second and final time because it belongs on a sticky note. First move is a proposal. The hold is the vote. If you made it to the end, drop RVP in the comments so I know you're here for structure, not noise. This is market structure education, not personal financial advice.